All right, S&P futures in red and Dow futures are in red. Indian market just no recovery whatsoever. Deepak Shenoy joins us now and he's been busy over the weekend. Deepak, I read your Twitter handle.
Yes, it's been crazy times.
Are these crazy times? Because the problem in a sense now is getting arrested.
Well, it doesn't seem to be the markets, stock markets don't seem to think so, for one. But I think the bigger problem over here is, clarity on what happens to the rest of it. I think First Republic is another US bank which seems to have had to borrow a fair amount of liquidity at the Fed window, the new window that they've created. So there is some feeling that some of the smaller banks will have an issue and all that stuff. But I think over the next few days, things should calm down. For the most part, I think the fears are out, are away, and we might, we should not see contagion from now on. But strange things happen to markets. So, I'm at least at this point, at some level, a spectator only.
Investor, Deepak, aren't you like wanting to protect capital and book out from wherever you're sitting in the money?
To be honest, Aisha, this might not be the right time to do, this kind of selling and waiting for a crisis to hit us. Usually, at times like this is when you get opportunities to buy, and you want to, because if you're in the market for like a month, then yes, there's too much volatility. This is not the time to invest and all that stuff. But if you're in the market for 5 years, already a lot of valuations have come down significantly, and now you're getting some stocks at very, very attractive prices. And we think that going forward, if the economy starts to rebound and do well, especially because India seems to be relatively more isolated from all these extreme movements in both interest rates and also extremely high inflation. I think that stability is going to do us well for the next 5 years. So I'm actually quite bullish for India as a whole. But the next 3 months, anything could happen. We hear the cricket commentary, all three results are possible, but that's what it is. And the next 3 months are going to be crazy. Next few months may be crazy, but I think, this is actually, this is a time to be bullish, not to be away from the market.
It's turning out to be a rather ugly session for sure. I mean, that is something which is evident. Nuresh, you still maintain the view that we are weak, but it's not going to be a sharp fall. It's going to be a gentle grind. But do you think it's going to get closer to 16,000, 16,000, 17,000, 16,800 or 16,500? Where do you think eventually we will go, Nuresh?
So I'll go to the fact that what is the fear which is going on in the markets. SVB Bank collapsing brings down all the memories from 2008. So we saw the first action happening in Bear Stearns in 2008 March, and the index corrected for the next 2-3 sessions, and then we saw a 12 to 15% rally across the world, and then we saw the indices fall 50% over the next 6 months. So that is the fear which comes back to the market, and that is why we are seeing the same reaction. So the first action has taken place globally, and it's very difficult for the same thing to play out in the next crisis. So that's my view. And in terms of Indian indices, we are consolidating rather than falling off. So the view is we find some base around 16,800 to 17,100 mark, and I would be looking at an accumulation zone at 16,900 to 17,100. So I expect a bounce back from this zone, and say similarly a bounce back in global markets as well. Because when the first action takes place, that could generally create a short-term bounce. And given that it's a trade, and I would keep a stop loss at 16,750 and look for a buying opportunity in the next 5 to 6 sessions going into the Fed policy by 22nd March.
Seems to be in a bit of a hurry to even breach that 17,100 mark. We're down to 82 points right now, so pretty much at the day's lows. Kunal, what happens next if we were to breach 17,100, which seems like we're pretty close to?
No, I think these are just, I would say, more of technical or sentimental breakouts. But I think what's actually happened is that the back of this strong uptrend has been broken. So we were trying to look at it this way. We were trying to protect the 70,200, 300 mark for the last 1.5 to 2 months approximately. And once that level is broken, and on a day like today, where the expectation was that the markets would probably get into at least some kind of a recovery, if not into a strong positive closing. That generally dents the sentiment for the markets over the near to medium term. Now, the most interesting data which I'm looking out for in the index is the massive rise in the shorting of bank nifty futures. Now, I was looking at the last 30 days of comparison. There was hardly any jump in the open interest. In fact, over the last 10 20 days, there was actually a reduction of open interest. Today, the addition in open interest is almost 20%. This is like a cumulative open interest which generally happens in a month. So today's traders typically have gone fresh shorts on the indices or maybe hedged their portfolio, and today's the first day we've seen that happening. So till the time today's high is not broken out on the upside, I think it's going to be a very difficult call to try and go contra even in this kind of a market. I think either traders should try and stay away from taking any long positions over here, or if possible, someone who has a high risk appetite should even look to go short.
Go short.
Yeah. Okay. So that's what our view has been.
Yeah, I'm just saying, just
7,200.
confirming it again, because going short is something which you've not heard this year. You've not heard this year, and that's the difference. That now the trade which was buy first, what was the trade? Let's say at the beginning of the year, you got to buy the market, and if markets fall, stay with the market. Don't panic. And if markets fall more, buy more. Then the view was that okay, this market is going to get jammed, so sell when you get uptick. But now the view clearly seems to be technically that you sell the market. No, you short the market. And there's a difference in sell and short. You own what you sell and you short what when you expect markets to go down. So there's a big change in terms of what Kunal seems to be indicating as a very basic approach. Deepak, from morning we've been discussing that why this is not 2008 and what are the similarities between 2008 and 2023. What are your thoughts?
So, I mean, as much as I've seen, I went through 2008. I think 2008, actually, the crisis started in 2007 in July in the US and, kind of exacerbated with bear stearns falling in January. And India correspondingly had a large IPO set of issues. And that coincided with the market fall in January. And then it moved on. Things were very different. If you remember 2007 and 2008, there was an extreme air of bullishness that preceded the fall. So the fall came as a kind of a surprise, saying, oh my God, is the economy not doing that well? Are these banks over leveraged and crazy? Today, we have an opposite scenario in the sense that people are actually very circumspect. They're very skeptical of any good news. There is 1.5 years of nothingness that has happened to the market, and there is a lot of fear around interest rates and inflation that continues to go. But the markets are relatively in a better shape, and domestic investors are continuing to invest. Foreign investors are selling, and there is a lot more fear today than there used to be before the markets cracked in 2008. I think so. It's a bit of a different phenomenon from then to now. And also this time the leverage in the banking system is not so much. There's leverage in other places, but not so much in the banking system. In fact, the Silicon Valley Bank collapse or even the other banks that collapse are not because of bad lending. It's just because of interest rates going up, which is not so bad a cause, because then you can rescue the bank in a much more controlled fashion. So I think in general, the feeling right now that I'm getting is people are too scared, and that's why they equate it to 2008, whereas the fundamentals and the dynamics are actually very different. We actually have far worse fundamentals than 2008. 2008, the economy was growing in India at least, and even the US. Right now, things in the US and India are not growing quite as much. So the opportunity to grow from here is possibly higher if the interest rate cycle and inflation cycle turns. Which is a very different feeling from what it was in 2008.
Difference, and that's the leverage level in my book. The leverage level of the balance sheets are different. The prop books of the banks are not there. A new act has been passed after 2008 where the scrutiny of the banking system by the regulator is very, very different. Markets does not, like Nuresh was saying, that market do not react to the same problem again and again because markets get used to it. And I remember as a market commentator in 2013-14 when the crisis happened in Greece, the word pigs was coined. And we don't talk about it today. I mean, that time from banks to countries, we've discussed that, okay, you know what, this is going to be a bigger crisis because you're talking about countries going bankrupt. And the word pigs was coined. and that is not being discussed now. So that's how memories are. We tend to overreact in the short term. We tend to underestimate the power of human resilience. I think the way central banks have acted, at least the way Fed has acted, they've not waited this time. Unlike the 2008 crisis, they waited for a lot of days and the collateral damage happened, and then they had to rescue the banks with the US tax holder money. In this case, today who's taking the haircut? Depositors are not taking the haircut. The haircut has been taken by equity owners, equity holders, and bond holders. Those folks are paying for the misjudgment. True. See, if you made an investment, if you lose money, that's a risk which you've taken as an equity market investor, as a bond market investor. So you entitled for the upside, but you have to also accept the downside.
Take the hit, yeah.
So I guess that is what is the differentiating factor, if you frankly ask me, that this time around the bailout is not by US taxpayer money, or it is not Fed which is coming out and giving credit to the banking system per se. All you don't want to see is that you don't want to see run on banks, some other banks. Then there is a problem.
Yeah, seems to be the case. Okay, by the way, Reliance is now at a 52-week low. The stock is struggling around 2280 thereabouts. That's cracked hard. Infi, like we've pointed out, in any case, is down and out. The HDFC twins as well. I mean, to think of it, HDFC Bank was only about 2% away from its 52-week high and one of the best performers year to date. That rally also seems like it's going to get stalled. But Deepak, you were talking about as to how in this decline, you would use this as an opportunity to buy. But what do you buy? Do you buy more of the same, or are there newer names which you would be looking at?
So for newer names, Aisha, I think, we have result season coming up soon. So we might wait to, we've been buying some new names, but, we'll build real positions on them after results. But there is actually, look at, like, say, the USD INR, look at our bond yields. Those markets haven't, gotten destroyed or moved any meaningfully negative way against us. So I think on the whole, the economy seems to be in a far more stable state. So I would still say the shift now is to domestic manufacturing. The shift now is to some sectors which are going to disproportionately benefit. For instance, you got railways, you got defense, core infrastructure, capex. So I think these are cycles which will continue. Of course, interest rates are going up, so there may be a little delay to this, but eventually rates will come down. As inflation will moderate. Today evening inflation numbers come in. That might tell us more about how our economy, how our inflation numbers are. And later this week when the US numbers come in, I think how the world economy. So I think much about, buying right now in terms of portfolios will be able to reposition yourself. I think some of the names that made a lot of money for us in the last decade when interest rates were relatively low across the world are probably not what's going to work in the next decade. So high PE, high quality company growing at 12, 13% is possibly not where you want to be, whereas a relatively low, less leveraged, but with some leverage, manufacturing company that has a very wide landscape will probably provide the growth in the next decade. So it'll be a small phase shift, but it's a phase shift that's important for portfolios.
No recovery whatsoever. Naresh, would you chance your arm to buy out of money calls?
So I would wait a little more because I don't like to preempt when there is a lot of announcements. But I would go stock specific. So the strategy to be in defensives has worked out well. So the PSE index is actually, none of the stocks have really fallen or actually gone up 5 to 10% over the last 2 weeks. So my view is the same. I would rather go buy a power grid at current levels or a ONGC than to chance an arm on the Nifty and the Bank Nifty.
What should markets expect in terms of a sequence of news flow? When the problem came, everybody was looking up to Fed in terms of a indication. They've stepped in, they protected the depositors. There is a Fed, so the Fed has done what essentially they wanted to do in terms of the rescue or the bailout package. But in terms of sequence of events now, what should markets monitor? What should markets be generally worried about? Deepak?
Oh, sorry, this is for me. Okay. I think monitoring, from a monitoring perspective, two things. If there is a flight to safety in terms of people running out of equities and into bonds in a meaningful way, that might mean this downturn will last a little bit longer than we imagine. And otherwise, this current crisis is probably going to be over in a week if things are allowed to recover where they are. The other point is contagion. You want to see whether yeah, what's happened in the US is to a relatively smaller bank, although it's a very large bank, it's bigger than HDFC Bank, but it's to a small bank in comparison with the US thing, and it's a very relatively regional bank, only 150,000 customers in the bank and so on. If you look at Europe, their economics and the banking system is far more leveraged and has far worse quality of assets, and has way lower governance standards than most of the US banks do. So I think if the contagion spreads there, then we're going to have a different kind of a market response. So that's something to monitor. In India, I think the point now is to look at annual reports and results as of April, which will give us a very good idea of how things have panned out in the last quarter, and if there will be a little bit of a slowdown in comparison with what used to be earlier. But I think we should get some really good commentary going forward, at least in terms of demand. We're not seeing industrial demand meaningfully down at all. And we're slowly starting to see a rural recovery. So I think I'm bullish there on those aspects. Monitoring wise, it's the next 3 months or 4 months where you got this high inflation, high interest rate, potential busts and defaults that are the cycle to watch for. And I would say in India, watch the NBFC sector. Cost of capital is going up quite tremendously, quite heavily, even within India for riskier credit. So anybody who's the risky end of credit is seeing 9 to 10% at least borrowing costs, which used to be 8.5% or 7.5 to 8.5 earlier. So they've seen a phase shift jump in their credit costs, and that means certain NBFCs will have trouble refinancing. Beyond that, I mean, I don't see a full-on crisis, but then I've been wrong before. Who sees a full-on crisis before it happens?
Right. Just looking at what's actually holding up in the market, it's not much really. There's Tech Mahindra, which continues to stand in its pole position. And then, of course, this Apollo Hospitals, Sun Pharma is resilient to some degree. Balrampur Chini, which is mildly in the green, and guess what? United Spirits is the one which is holding out. That's what people would need today, right?
No, Adani, if you frankly ask me, if you are looking at risk...
That's now drifted in the red, by the way.
No, it should have fallen much more. If the collateral damage for... I mean, you know that institutional investors...
But then they've had positive news flow as well coming out, right, over the weekend, or I think on Friday evening.
No,
weekend.
Yeah, so there is a rumor. There's a rumor that there's a buzz rather that they are looking at two things: selling stake in Ambuja and repayment. I think was what the Economic Times today has reported, that they've repaid debt. What? No, Aisha, the point is that how a group which triggered the market nervousness in the month of Jan and Feb today, at a time when nervousness is getting triggered across the world, is not falling. Why? Because you know that the buyers and the sellers now, there's a buyer in the town. And he's a big buyer in the town who's got a reasonable amount of appetite. So sentiment changes as the profile of the news changes. I'm just bringing a point out that today it's an anticlimax that you would have imagined in a weak market, this entire group should have got this, it should have been down by 5 to 7%, considering where they are. Adani Enterprises down 1%, yeah, I mean, now it's drifting lower. Nuresh, does it make sense to revisit Adani group of stocks? The weak group of stocks today are becoming the strong group of stocks?
Not really. See, even in the good times, it was something to avoid, given that low float and say not much of an institution participation. The stock which still looks interesting would be Ambuja Cements. That's a stock where the new base should be 360. So you want to buy closer to that. So I think the opportunity in the whole group is in Ambuja Cements. That's a stock which can eventually go towards 420, 450. The rest of the names could stay sideways. And say if you want to participate in Adani Green, Adani Power, the problem is you can enter, but the exits are on lower circuits. Entry is on an upper circuit, which is difficult to get in also. So there is a lot of impact which is difficult to assess. So I would say if one wants to buy the Adani group, look at Ambuja Cements on declines from here.
Adani Group has fully prepaid their $2.15 billion share-backed financing ahead of deadline, and I guess that is what kept some of the stocks resilient up until this last-minute crack that you are seeing on those stocks. Okay, just minutes to go before we wind up for the day. So let's get in some BTST trades as well going. Kunal, what is it? STBT
Yeah,
or
STBT.
ST?
ST. Yeah, maybe STST could be a better word, but then sell today, sell tomorrow.
Sell tomorrow. Come on, Nikunj.
So two sell calls. The first one is a sell on BHEL, a stock which I had, I think, suggested a sell 2 or 3 days back. So would maintain the bearish stance on the stock. Targets revised to 72. Stop losses trailed to 76. So traders can look at initiating a fresh short even at current levels. The second would be a sell on L&T Finance. This is a fresh breakdown for the stock, breaking below the 50-day moving average, which has been a big support for the stock. So sell targets of 82, stop loss at 88.
Right. Naresh, what about your BTST ideas or STST, whichever one you would pick and choose?
So it would be a buy and a sell. So it would be a buy on Power Grid, the defensive stock, which is still actually positive for the day by just 0.1%. The stock still looks interesting. Could see a move towards 230, 32 levels. A stop loss at 224. Second is a sell on Eicher Motors, which has given a fresh breakdown below that 3100 mark. Could see a slide towards 2900. A stop loss at 3070.
Where do you think, Deepak, this market has overreacted and you're just waiting for a bit of a turn, maybe a couple of days, and you want to be a buyer? I mean, you've identified that name, that group, or that idea.
Yeah, I mean, we're still buying some, so not taking any names right now, but we're shifting a little more into some companies in the engineering space, which are primarily either supporting manufacturers or are primary manufacturers themselves. There is value here. I mean, these are companies now with 10 to 15 times earnings kind of valuations, relatively smaller caps. We're also seeing some value in the extreme large caps. I've been a LIC buyer for a long time. I continue to be buying that stock. I think big positive surprises come in the last quarter as well, and some more clarity on a few things that I wanted. I believe will come. Also, if you look at the market as a whole, there are a lot of players which haven't moved for 1.5 years. Whether it is HDFC Bank or whether it is Reliance or a bunch of these guys, there is I think the fact that they are not breaking down substantially below where they used to be and also not breaking out gives them the ability to have made their earnings a lot better and their book a lot more resilient in the last 1.5 years. So if I were to say, building positions, I think you'll have to build a combination of these positions, some extreme growth, some just that good stocks that have just come into territory where price is reasonable. But next 3 months, think of anything you buy as 30% down the minute you buy it. This is one of those markets, uh, but I think it's better to be a buyer if you're in a 5-year zone than to be a seller.
Okay, fair point, Deepak. But what is it that you would steer clear of right now? Let's put it that way. Not sell, but avoid.
So I think some of these, so the companies that, for instance, I told you, Aisha, the companies in the quality space where we're looking at 10 to 14% growth at best, but earnings multiples are 80 times and 90 times, ROCE of 25, 30, 35%. The ROCE won't matter now when the growth metrics are more important because you have to grow to beat inflation and interest rates. You're not going to be able to get this kind of PE valuation anymore. I think that is where you're going to suffer a little bit. If you're paying high PE, make sure you're paying it for high growth. That's where I think the avoidance part of the market will be. There's lots of them, of course. I won't name because it's unnecessary, but I think rejigging your portfolio to reduce the ones that are good companies but very high PE, not likely to grow very much in the next 4 or 5 years, to companies that relatively have a better risk reward in this equation. I think that's the phase shift. Again, not I won't say that these are bad companies. It's just that the prices are not good enough, and there are better prices available today. I would downright avoid highly leveraged companies, highly leveraged NBFCs who are dealing in unsecured credit, some of the microfinanciers, because right now the input costs and the default potential is substantially higher than it was 6 months ago. And I just want to steer clear of trouble here.
75 points higher for the Nifty. No. When higher, I say from the day's low. No, Deepak, don't look at the screen. I'm completing my sentence. I was hoping for that reaction.
Recovery from
the day's low. 75 points higher from the day's low, recovery from the day's low. So you will just close here or there. The fact that 17,200 is broken, it just shakes the market. So what happens, Kunal, if in next 2 days the 17,300, 17,350 is regained?
No. So as I
Now
said,
it does not.
It doesn't count because till the time today's high is not broken out, we should not be ideally taking any long positions because there would be counter rallies. There would be false rallies in between for the markets whenever we go into an oversold kind of a price action. And post that is where the trend starts off. So the breaking of 17,200 is an indication of a new trend which has begun. So between a trend there would be of course counter rallies which could be very much possible.
Okay, now 2 follow-up questions. In your assessment, if this is a new trend, every new trend in a sense has a quantum which you would say scale. So in the scale of 1 to 5, how convinced are you about this downtrend?
I am pretty much convinced. So I'm not sure what is 1 and what is 5. If 5 is the highest, then
obviously.
Yeah.
ये उल्टा कौन खेलता है?
Short में उल्टा ही खेलता है.
Why? Number one conviction. It's
Okay,
gonna fall
let me
more.
define it again. 1 to 5, 1 being lowest, 5 being highest.
I think I'll be closer to 4 and 5.
Okay. What will force you to change your view? What is that level of mark?
So 17,550, which was a gap, 580. So maybe 17,600. 600 approximately.
Nuresh? Okay, 1 minute left. Nuresh, I'm going to wrap the market and then get this question out from you. We are about to close almost at the lowest point of the day. So that 20 points, 50 points, frankly, does not matter. That wall which we were talking about of 17,300, Lakshman Rekha wall, it's been broken. The breadth is just dented. And you've gone down when US markets did not fall. It was largely because of what happened in Europe. And now there is a fear of contagion which clearly seems to be there because European banks are down. Financial stocks across the globe have taken a hit. While we can argue back and say regulators have have stepped in and the fear of contagion is not going to be there, but the levels of the leverage and the interest rate hike in the world is so steep that the casualty rarely stops at just 1%. Bitcoin would be the interesting one. We just mark the Bitcoin right now because Bitcoin in the morning had rallied 10%. I haven't checked Bitcoin after that. So it's a bad day. It's a poor day. In the morning when we started, it appeared that the worst is behind us. There you go.
Bitcoin, Ethereum up 9%.
So dollar index is down and Bitcoin is up. Is it one of those days where it just pure technical pressure for the equity market? I don't know. All I'm saying is that it's not that bad and that scary as the news and the macros, and if I look at other assets also. See, by now Bitcoin should have gone down and dollar index would have spiked up. Or for example, something would have happened to the global volatility index, which has also not gone up. So I'm hopeful that we go back to day of sanity, provided we don't see any more casualties in next 24 hours or next 48 hours.
Okay, but can't negate what has happened today. It's been a rough start to this trading week. We'll wind it up right here and we'll see you again with all the market action tomorrow morning.